Hi everyone, this video looks at the IR35 personal service company regime. It replaces an earlier recording I did just to make sure that things are up to date as of tax year 23-24. And the good news is, as many things have been frozen, anything true of 23-24 is likely to be true for a few years going forward. I'm not looking at all the detailed rules, I'm just trying to give people a bit of an overview of what's going on. So why did they introduce the IR35 rules in the first place? Well, here's why. Let's imagine somebody working on a salary of £90,000 and in reality they're an employee. They're doing work for an employer in the capacity as an employee. Now, if you simply did that, you went on payroll with a salary of 90 grand, you would end up suffering income tax of 23,432. I've not taken you through the workings. It's simply take off a personal allowance and then tax at 20 and 40%. And you would also suffer primary class 1, 5319. Again, it's a pretty straightforward primary class 1 national insurance calculation. The employer on top of that would have to pay secondary class 1s of 11,164. So in total, the taxes suffered are only just shy of 40 grand, which is an overall tax rate, national insurance included, of over 44%, which is quite a lot. So people inevitably wanted to think about ways to minimise this tax bill. Now, you've got to remember that the initial legislation, as I'll come on to in a minute, came out in 2000. Finance Act 2000 feels like only yesterday. So it was trying to address an avoidance scheme that people were doing through the 1990s. So what did people do? Well, rather than going on payroll for the employer, our individual would set up a company, a personal service company, in which they would own 100% of the shares. They would still work for Employer Limited, but they would have their 90 grand salary paid into their personal service company. So it was just invoiced and then the invoice paid. They would then take a small salary just up to the national insurance threshold from their company, and they would take the rest of the money out as a dividend. Now, their personal service company would have to pay corporation tax. Again, a bit of a messy calculation, which I've not bothered showing you, because on the profits the company would have, it would be in the marginal relief band. But anyway, you can try it out if you want. It comes to a corporation tax bill of 17,688. The rest of the money in the company they would then take as a dividend. Now, when they did that, again, I've not shown you the calculation, you can check it if you like, but for 23-24 rates, they would end up with an income tax bill 10,650. And if you then add up the total tax, it's just the corporation tax and the income tax, total tax is now only just over 28,000. A rate 31.5%. Now that's a lot better than 44. It's saved over £11,500. And you can imagine with those sorts of tax savings on offer, people were thinking, yeah, I'll have some of that. Now, it could actually be even better. You can reduce the tax further if you don't take all the dividends out of your company, but that potentially does leave you with an issue going forward. How are you going to take the money out? But there's further tax to be saved if you had a non-working spouse. Because if you had a non-working spouse, then you could employ your spouse to do a little bit of work for your company, answer the phone, arrange the diary, keep the accounts. Quite easy to justify a £9,100 salary. So you're now paying the salary to £9,100 to each of you and your spouse. That then reduces the corporation tax in the personal service company, but it also now means that you can make your spouse a co-shareholder in your company. So you're not 100% shareholder, you and your spouse 50% each. You now split the dividends. The dividends now fall into basic rate. So your income tax is now slashed. You're both of you paying just over £2,000. Total tax under 19,500, you've now brought your tax rate down to 21.6%. And the saving from being employed is over 20 grand. So you can really understand why, when this was sort of okay as a tax planning move through the 1990s, increasing numbers of people started to do it. So inevitably, when the Treasury see a good tax planning scheme, they look to block it. So the first thing they did was Finance Act 2000. They basically said, if you are the owner of a personal service company, you supply your services to an employer, you invoice through a company, then you had to look at your relationship with the employer, ignore your company, and say, in the absence of your company, would the employed v self-employed test suggest you're an employee? If the answer is yes, then all the relevant taxes are borne by the personal service company, because in simple terms, the money that's paid into your personal service company is all deemed paid to you as a year-end salary. And therefore, your personal service company has to account for the employer's NI and then pay as you earn and the employee's NI on that deemed year-end salary. Would you believe very few people decided that the rules applied to them? So people would operate like that. They'd have a look and go, no, I think I'm self-employed. And therefore, pretty much nobody owned up. So it was very much up to HMRC to chase people, which they did in a range of high-profile cases. Many well-known people, Lorraine Kelly, Eamon Holmes, a couple of fairly recent ones got attacked, with differing levels of success for HMRC. Lorraine got away with it, Eamon didn't, as of the moment, although subsequent appeals may change that. From April 2017, the Treasury decided that because they had this issue that it was up to the individual to self-assess, and pretty much nobody was going to, they said, right, we need to sort of change the focus. So they said, if you work for a public sector employer, then we're going to change the onus, and we're going to say the public sector employer has to do the employment status check. And if they decide that the relationship is really employment, they must put you on payroll. And even if you invoice through a company, they will pay your company's bill net of pay-as-you-earn and national insurance. The Treasury were obviously very happy with the results of this, so they then decided to extend it to the private sector. It was originally going to be extended in April 20. COVID delayed it by a year, but it did get extended April 21. So now, if you are a private sector employer and people do work for you and they invoice through a personal service company, you, the employer, has to do the employment status check. And again, if you decide that they're employed, then any invoice that they send to you, you have to pay net of pay-as-you-earn and national insurance. The only employers that doesn't apply to are small private sector employers. You can see the definition of small on the slide there. If you're a small private sector employer, then the onus to do the employment status check still lands with the worker.